are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good Monday morning, February 13th. You're listening to 103.9 FM, LI News Radio, and this is Money in the Morning with Mitch Goldberg. We are set. We're going to have a good week. All right, so the Dow is trying to, well, the major averages are trying to find solid footing after last week, which is the worst week of the year so far for the major averages. The year is still young, so I still think it's too early to start really making a big deal of what is the best week or the worst week of the year so far. I think we need to finish up March, and then we could start talking with more superlatives like that. But last week, Dow was down 2.4%, S&P down 1.1%, NASDAQ down 2.4%. Today, the Dow futures this morning are looking to be down 19 as we speak. They were up a couple minutes ago, but they've been going back and forth, positive, negative. S&P up fractionally, up 3.5 points in the futures. NASDAQ futures up 40 points. Oil looks to be off about 65 cents a barrel. Didn't quite close at 80 last week. 80 is like the demarcation zone for oil. You know, over 80 and you really start to see gasoline at the pump go up. Under 80, I feel like we're still okay. A friend of mine told me he filled up at a Costco. I forget which Costco. Is it Lake Grove maybe, or the one by the mall? I don't know. Which Costco that sells gas he filled up for like $3.13. Not bad. 10-year yield 3.7%. That is the big shocker. 3.7%. We were just talking about that 2 weeks ago, 2 Fridays ago, in fact. The 10-year was in the 3.3s, like 3.38, 3.39. Then we got that shocking employment figure, 517,000 new jobs, 21 and 2022 job figures are actually revised higher. And ever since then, the stock market has been on its back foot trying to figure out what's going to happen with interest rates and the Fed. And the Fed apparently has more work to do. And although Jerome Powell, Fed chairman, was sounding dovish, it sounds like he's trying to walk that back, making comments recently at the Washington Economics Club saying, well, you know, we could have a long way to go. We could see inflation perk up again, and we have to be ready for it. So right now, the Fed futures are targeted at around 4.75%. We all believe we've got 2 more rate hikes in the tank to get to 5.25. I hear some rumblings of maybe getting to 6%. At what point does the Fed say we're at the end of raising rate hikes? Obviously, we won't know until after the fact. The Fed has continuously said it's data dependent. So we are not going to know for a while, and unless economic statistics really point the way and say job market is slowing down, wages are not going up as much, or flat. Hourly hours worked per week are starting to go down a little bit, and first-time jobless claims, which comes out every Thursday, have to start going higher. We're just not getting those, and it's hard to say that the Fed is done doing its job. It kind of feels like the Fed's move. It's clear the Fed's interest rate hikes haven't really done much to slow the economy. Now, inflation's been coming down a little bit, but tomorrow we get the next consumer price index figures. And they're expected to come in at 6.2% year over year. If they come out higher than that, I think the stock market takes another dip down, because then the whole peak inflation thing kind of goes, I don't want to say it goes out the window, but it gets moved further out. Well, FedEx, Carvana, Room, Coinbase. I really should have. This is interesting to me. I'm kind of totally going off script here. Okay, but yesterday, Super Bowl. What a game! I hope all you guys got the right boxes in the pool. But the numbers are out for FTX, Carvana, Room, and Coinbase. These were companies that are publicly traded, hot new growth companies that advertised at the Super Bowl last year. And FTX is basically worthless. Carvana down over 90%. Room down. GM down. Betting on companies who are advertising on the Super Bowl is a pretty piss poor endeavor. So I know we enjoy the commercials. I certainly do. So just wanted to throw that in there. That's my commentary on the Super Bowl. That's how I think. I think, gee, that company's spending an awful lot of money to advertise. Is it worth it? It's also what the first 10 years Pepsi sponsored the halftime show, and this year for the next 4 years it's going to be Apple. I guess makes sense because Apple has all the money in the world to do whatever they want. So let's get back on track. All right. So we have the futures basically flat, trying to figure out what to do this morning. Oil is just backing off a little bit. The 10-year yield, as we spoke, is 3.726%. And, that means mortgage rates are not just on the flat line of 6. They're going to hit probably mid-6s very soon. And in about 2 weeks, we're expecting the home selling season to begin. So we shall see how that works out. Now, I want to talk about the home selling season real quick because it's starting soon. And I know around Long Island, people are worried about the value of their homes, especially if you've bought a home as of late because you've really paid up for your home. Here are the things that I think makes housing very stable and not susceptible to a crash on Long Island, okay? First of all, anybody who bought a house with a sub 3.5% mortgage rate is never moving. In my opinion, they're never going to move because to buy a bigger house or to upgrade, even to buy a smaller house that's cheaper, the rates are so much higher today that it's not going to be cheaper if you're financing. So that, to me, keeps people in their houses basically, forever. Okay, there's no reason to move. The other thing is we have an inventory shortage, very little building going on. And even the further east you go, it used to be, further east you went to Long Island, the cheaper it was to live. No longer the case, really. Okay, houses are expensive everywhere, and we're no longer just an offshoot of Manhattan. Long Island has its own economy. It's not just like dependent on if you want to have a longer commute, you get a cheaper house. The commute doesn't really matter. The commute is just driving now. It's no longer dependent on the Long Island Railroad into Penn Station. And I want to just talk real quick about Zillow. Zillow is kind of like the stock market for housing. You look at Zillow and see what prices are doing. But my thought of the day, I don't know if that's really a thing, thought of the day, but if you see that your house is worth a certain amount of money on Zillow, let's say a year ago you looked at Zillow, and you see that the value of your house is down 5% in the last year, does that mean you're going to panic and sell your house because it's down 5%? Down 8%? Oh my God, we have to sell this house. It's going down in value. We have to put a stop loss order on it and sell. It doesn't work that way. And I don't think it should work that way with the stock market either. And just like you don't rely on a day-to-day measurement of the price of your house by checking out Zillow to make your housing decision, I don't think it's worth your while making a day-to-day decision about your investments, your 401k, et cetera, based on a quick, snapshot of the major averages. By the way, you can't invest directly into an index, but you can invest into a security that tracks or mimics an index. This is Money in the Morning with Mitch Goldberg. We're touching on the topics that are important to you so that you can potentially become the best version of your financial self. You're listening to 103.9 FM, LI News Radio. We thank you so much for joining us. Stick around. We'll be right back after these brief messages. Okay, we are here for the second half of Money in the Morning with Mitch Goldberg. I just want to squeeze in every minute I can get into this show because the time, it just goes by so fast. Like when we are done with the show, I'm like, how the hell did this half hour go by so fast? It's crazy. Okay, so let's talk about a topic that people love to talk about. And that topic is beating the market. Can you beat the market? Okay. Now, there is a mountain of evidence that says you can't beat the market, you can't time the market, you can't outperform the market. So you might as well just diversify. By the way, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Having said that, the standard Wall Street investing advice, which I agree with for most people, is invest in broad-based indexes that track, broad-based parts of the market, international stocks, large cap stocks, mid cap, small cap, bonds, etc. And instead of trying to beat the market, go for an average return of these asset classes. And depending on which proportion you have them in, you'll be taking more risk with a little bit more volatility, maybe a lot more volatility, or you could take less risk with less volatility. And it depends on your age. So the older you are, they say the more conservative you get. I don't think that counts for all of your money, which is why I don't think you go all into cash and bonds when you're older. And I don't think you have to do that because we're living longer. We still want that hedge against inflation, which stocks historically have provided. And as you get the way you determine your risk tolerance is your time horizon to when you need the money. So as you're getting closer to needing money, you get more conservative so that you're not subject to a substantial drop in the market, which could set you back a long ways. The reason it sets you back is because you have to sell more shares of your investments to raise the amount of money that you need. And if you're selling more shares of your investments, you have less opportunity to recover when the stock market goes back up. There's a term for that. It's called negative sequence of returns. It's very real, and it basically means that those few years before retirement and those few years after retirement, that's when a negative sequence of returns can really hurt you the most financially because you're so close to needing the money or you're just starting to need the money. That's why in advance, you start to put your financial obligation needs into cash. You don't have to worry about a negative sequence of returns. I hope that makes sense. But we need to do that. And I think a lot of people get caught up and said in the last couple of years, I'm not getting anything in the bank. So I'm going to continue to own these dividend payers. This stock pays 4%. That stock pays 5%. That's what I'm going to keep my money in. And I'll get out when I need the money. But those stocks, as you can see, are down a lot also. The Cloroxes of the world, the Verizons of the world, the AT&Ts of the world, which cut its dividend. So it's not just so easy as buying dividend-paying stocks and say, I have my money in a stable place. It was a huge mistake amongst baby boomers. I see it all the time when I look at prospects. I look at their accounts, look what they're doing, and I look at why they're so miserable and unhappy about their investing because they were hit over the head. They thought they were doing everything right. All right. So that's that. The other thing you could do is, besides investing in broad-based averages, in indexes or securities that follow the indexes, you could put in a smattering of high-quality stocks, blue chips. blue chips, I think it's a little subjective of what a blue chip is, but basically blue chips are the companies that you have heard of. They've been around for a very long time. They often pay a dividend. I'm not saying you buy a stock because it pays a dividend. I'm not saying if it pays a blue chip, it's a dividend. If it pays a dividend, it has to be a blue chip. But basically, that's my litmus test. I'm looking for brand name companies. So you could do it that way. And you're taking more risk because if one or two of these stocks eventually craps out, and we've seen that happen before. Look how IBM has done in the last 10, 15 years. Look what happened to AT&T. I could pick other blue chips like General Electric, which, when I got into the industry, GE was like the first stock. GE and IBM were the first two stocks you would buy. And they've been horrible performers for the last 20-something years. So you're taking more risk in that regard. But there are people who have beaten the market, and I could tell you that because I've seen them. But they didn't do it because they were traders. They didn't do it because they had a superb investment acumen and a superb sense of market timing. They did it because they were patient. Because how many people bought Apple or Amazon and just held on to it and ignored it and just rode the wave for the last 15, 20 years? Those people who've done that have done extremely well. And so you look at Warren Buffett. How does Warren Buffett do it? Warren Buffett is the first person to tell you, I'm not a trader, I'm an investor. And his core competency is his patience. And that's what I like to say to my clients. I said, I'm not the best at market timing, so I don't engage in it. But I'm really good at being patient. That's my strong suit. And I'm good at keeping people engaged so that they don't get bored, they don't sell, they don't give up. I want to keep people engaged with their portfolio, their investment strategy. And that's what you need to do. How you do that is up to you. You could be someone who likes to ignore your investments, and that's okay. Doing more is actually the worst thing you could do. Fiddling with your investments all the time, trying to be in the right place at the right time, from my experience, it's the worst thing you could do. Being patient and waiting is the best thing you could do. That has nothing necessarily to do with security selection, but I think being patient and waiting is actually more important than security selection. People are always looking for a Sunday punch. And I'm just going to put all my money into crypto or into the next pot stock, which have been obliterated, or the next, AI stock, which are doing well now. And it's actually probably some of them are, in my opinion, have gone up so much. I just feel like, how could you buy that now? So you have to decide what's best for you. The best investors, people who come to me who are already really good investors, in my experience, are the ones who know what works for them. And I keep them on that. And I learn from them. They learn from me. And what I do with clients who don't yet have their investment strategy in place, what works for them, is I help them discover it. And then we hone in on that. And that becomes the center of the investment strategy. It's a pretty cool thing to do. And it's very eye-opening. And it's actually a lot of fun, that whole education process. So I've often said I have the heart of a teacher. So these are the type of things that you need to think about if you're a DIY investor. You do this on your own. All right. So can you beat the market? I think if you are really good at waiting, buying quality, I think you have a reasonably good shot over the long term at beating the market. If you are afraid, you can't hold, then I think you go with what's tried and true. Investing in a broad-based asset classes using low-cost index funds. And that's a fine way to go. And you could do well that way too. So there's more than one way to invest. We just want to help you find the right way. I'm Mitch Goldberg. I'm with ClientFirst Strategy, ClientFirstStrategy.com. You're listening to Money in the Morning with Mitch Goldberg. I so greatly appreciate you taking the time to join us. This is 103.9 FM, LI News Radio. And if you haven't done so, the LI News Radio app works very, very well. You hit the triangle, you listen to the station, you take it on the road, you'll never be without us. It's a great thing. So have a great rest of the day. And I just can't wait to speak with you tomorrow. The time goes by so fast. Stay tuned.
Securities and investment advisory services are often through FINRA SIPC. ClientFirst Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and ClientFirst Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.